Tesla shares moving lower this morning. Fourth quarter revenue and profits fell short of expectations, and the company says that vehicle volume growth will be, in their words, notably lower in 2024 compared to last year. Joining us right now is Colin Langan. He is Wells Fargo equity analyst. And does this come as a surprise to you because the street is selling the stock down today?
I mean, I think yesterday we got a bit of a trifecta of bad news. You have the comment on deliveries. I don't think that was as surprising. I mean, we kind of could see demand has been slowing a bit. I think the margin commentary was a bit of a surprise. They talked about sort of hitting a natural curve limit on bringing costs down. It's a big problem because they just cut pricing in China and Europe a couple weeks ago. So if you can't bring costs down, those pricing just hits your margin right away. So it feels like margins are going to come down next year, very likely. And then he also didn't back away from the comment about trying to get a 25% stake, which raises concerns about dilution if you're a shareholder here.
What do you think in terms of whether it's more important to have not get diluted, or to have Elon Musk there developing AI at Tesla? How would you come down on that?
I mean, the stock trades where it does because you're not paying for the core auto business, you're paying for the future ideas, and that is Elon Musk. But it would be pretty frustrating, I think, as a shareholder to, have to sort of dilute yourself to keep him around.
You've got a hold on the stock right now. 190 is where it's trading. In terms of the other big automakers, though, you like them less. Ford and GM, you have a sell on both of those stocks. Why?
I mean, I think the traditional auto, the industry is challenged right now. I think even what Tesla's talking about is right. Their demand is slowing. Pricing's probably coming down. Those effects are going to affect the Detroit 3 as well. They just haven't seen it as much. So I think we have pricing headwinds. We have capacity has grown way too much, partly because of all the capacity Tesla has added. And we have EV regulation issues for the traditional guys. So they're going to have to figure out a way of trying to maintain margins as they sell more unprofitable EVs, which is just a structural challenge for them that I don't think they're going to be able to meet.
That's a pretty bleak outlook. What would change your mind? Is there anything that could happen over the course of this year that would make you think, okay, maybe there's a time to look at it again?
I mean, valuation always matters, obviously. I also think, we'll have to see how the politics shake out. I mean, I think if you have a Republican, there's more likely some of the aggressive EPA legislation gets pushed out. I still think that's a problem through 2026, but I'd obviously be less bleak beyond that because I think the 2026 rules are probably largely intact.
So the big three can fall back on selling some SUVs, some regular internal combustion SUVs, and pare back on their EVs when things are crappy. Tesla has that's it, right? Well, they only have, they can't fall back on a legacy business. They've only got, I mean, I guess that we always knew that, but I never thought that could be a positive for the big three, that they can always do what they do best.
It's not really a positive. They're going to have to sell more EVs. It's just if the regulations ease, they have to sell less to hit the standards. So
you mean government standards to sell, not for demand?
EPA standards, yeah, not for demand. I think that's the structural problem we're seeing is that EV demand has moderated. And,
well, that's what happens when that's what happens when there's centrally planned economies, right?
Well, it's a problem with the Detroit 3, right? They have regulations that are going to force them to sell more EVs. The consumers aren't there yet.
Right. So. Colin, thank you very much.